Hi everyone, and welcome to this explainer video on DSRAs, or debt service reserve accounts. They're quite commonly misunderstood when it comes to project finance, what they're all about, how to fund them, how they can cause issues in financial models, and how to calculate ratios surrounding them. So let's take a look. So just a reminder what reserve accounts are all about. Reserve account is really there and hopefully something that you never need as a sponsor, and certainly the bank never wants to tap into it. It means that something's probably gone wrong. The reserve account is really there for a rainy day. And what the reserve accounts are for means that the company, the project company, is not receiving any revenue, any cash flow, and can't pay for certain items, and that might be insurance, it might be expenses, it might be the debt that it needs to service, either the interest or principal or both, and the company needs to dip into a reserve account. Now, obviously, for a bank, servicing debt is exceptionally important, and if a project company can't service debt, it causes quite a lot of issues for the project company and for the bank. So when projects are financed, the bank says to the sponsor, to the project company, you need a debt service reserve account. What a debt service reserve account is, it's an account that stores 6 months, 12 months, and really the amount of time is dependent on the number of debt payments per period and the project and the bank. But basically it's saying you need a number of different debt service amounts in this reserve account that's funded over time. What typically happens is that the reserve account is funded at financial close, so it's funded from day one, and it's forward-looking. So it says, what are your debt service payments going to be, your interest and principal over the next 6 months? Let's just use the 6 months as an example. And says that amount always needs to be in the debt service reserve account. Now, as you can imagine, as a debt is amortized, and it's usually amortized in a sculpted fashion, it's usually paid off in a sculpted fashion in project finance, the interest and principal payments change over time. The sum changes, the total amount will change. So it's not a typical amortization schedule. Sculpted debt, and we have a video on sculpted debt as well. Sculpted debt means that the repayments will change in line with the cash flow, in line with the revenue. So the reserve account always needs to actually be a different amount, and that's why there's a specific line in the cash flow waterfall in project finance models that says money going into and out of reserve account. So sometimes you have to put money in to fund the reserve account more because the balance needs to be more, but sometimes the balance needs to be less, and then you can actually release cash from the reserve account. So there we go. The debt service reserve account works as an additional security measure for lenders. It's generally a deposit, so it's a deposit that sits with the bank. That means that cash actually belongs to the project company. So a lot of people ask, but does the money go back to the bank? No, it's money that's been lent to the project company. And the purpose of the DSRA is to provide a cash buffer during periods where cash available for debt service, or CFADs, is less than scheduled payments. So the buffer allows some breathing room for operational issues and gives you some time to resolve them, in this case 6 months. And that information is from Liquidity, who's a great source of project finance information. You also get different types of reserve accounts. So besides for the debt service reserve account, or debt DSRA, you get the maintenance reserve account, or the MRA. And this is something, if you say, well, hang on, we're going to have major maintenance on this project for maybe 10 years, and it's going to cost a lot of money. Instead of having a massive cash outflow in 10 years' time, you actually build up this reserve account over the next 10 years. So by the time this major maintenance event occurs, you've got the cash built up, ready to be released. Another example is a liquidity reserve account, which is just a reserve account to give the project, again, breathing room and provide some liquidity if the project needs some cash. And there are more types of reserve accounts, lots of different types of reserve accounts that's very project specific. And as we've seen, this does lead to complexities in project finance models. And quite simply, the complexity comes due to this flowchart. So I put this flowchart together to explain the complexities. And basically that your debt is raised and the company says, well, I need $1 million for this project. And then the bank says, well, you also need a debt service reserve account that will fund partially from debt, partially from equity. And it needs to hold in it the next interest and principal payments. Let's say the next interest and principal payment, just for interest's sake, is $5,000. And let's say you actually financed this project 50% with debt and 50% with equity. That means that debt service reserve account will be financed 50% from debt, so $2,500. So we actually add that to the debt amount. So your debt amount is no longer $1 million, it's $1 million plus $2,500. And you can see now our debt has increased, but that means that your next interest and principal payment will also increase because that's based on your total debt amount. So now we probably need to even increase the DSRA amount even further. And this leads to circularity that eventually is resolved, and it's resolved with the use of a macro. In Excel, typically a VBA macro, and who knows, maybe that'll change over time. But when I was a project financier, we used VBA macros to solve for this DSRA circularity in the financial models. Let's now delve into the financial model to see what the DSRA looks like. Alright, so this is the Operis PPP template that I've been through before in another video, and I'm going to accept the terms and conditions here. And as you can see that if we go into the model, here is the page that gives you a summary, and there aren't any numbers filled out in this model yet, so we're going to be doing that in part 2 of the DSRA analysis. This is part 1. And you can actually see here that in reserves, we actually have the DSRA year look forward profile, and we've got percentages there that I'm going to be explaining. If I go to the inputs, and this has various inputs over here, we can see here that there's actually a section for the DSRA, and actually has the look forward profile as well. So I'm going to be explaining that. That's one of the inputs, just to note. And then over here, you'll have inputs as well to do with the senior debt and the repayment profiles. And here we have input actuals, so those are probably generated via macro, and we're going to be seeing that just now as well. Now, as I said, on your cash flow, you will actually have payments into a DSRA and releases. And you can see that over here under project cash flow, we have DSRA movements. And the DSRA movement is, if I go to it, and just using my RE Excel Explorer, we can see here it's actually summing up this DSRA movement. And the DSRA movement, what it's doing is it's summing up the DSRA releases, plus releases to required balance first period forecast, so that's releases based on the next forecast. Funding, so that's movements into the DSRA, actual funding, and then we have actual movements as well, and then the carried forward amount. So we've got the opening amount of the DSRA and the closing amount of the DSRA, so it's a cash balance. And we can see that a lot of this actually relies on what is the look forward profile, and that's basically saying how much money needs to be in my DSRA, how much money do I need to put in it, what does the balance actually need to be. That's what your look forward profile is what does the balance need to be next period and the period after, and can we start funding that? So that's the required balance forecast. So you can see here that this is what your cash flow waterfall looks like, and typically right after you pay off your debt, that's when you'll have your cash available for DSRA funding, and then cash will actually go into the DSRA over there. And you can see this project also has an MRA, so the maintenance reserve account as well. And then afterwards you'd have subordinated debt and equity releases into equity as well. So that's what a cash flow waterfall typically looks like after your senior debt repayments. So that's the debt service reserve account. Now you will typically see it as a balance. You can see that it's under current assets, it's a current asset, it's cash. And you can see there we've got the reserve accounts, the MRA and the DSRA under current assets. So you'll typically find your DSRA on your balance sheet as well as a current asset. It's cash that the project company has. In the next video, we're going to be delving into the DSRA. We're going to be filling out the template and seeing how the DSRA actually works.